So I gotta be honest here, I hate when people use the word never, but then again, I am titling this video, Never Put Your Money in a Bank Account. And I am also the guy that has a little bit over $90,000 in his bank account. So you're probably thinking, Tommy, you sound like a hypocrite. You're telling me not to do something that you're basically doing. But in reality, it's less than 18% of the money I actually have that's actually sitting in a bank. And in reality, the reason I have that money in there, it really does matter. And that's why I don't like the word never, because a bank account isn't really, for example, for investing, but it is, for example, for temporary money and money you need for liquidity reasons, okay? And that's super important. So by the end of this video, you'll know exactly what money to leave in a bank account and also where you should put your other money. And that's going to be into assets and into different activities. But I could end the video right here, but then it's kind of like, okay, so have temporary money here, money for assets and other things, but it really wouldn't give you an actual game plan on what to do. So by the end of this video, the goal would be, you know exactly what to do with your money when you actually get paid and for what you should be using it as far as for financial freedom for the future. But just leaving your money in a bank is a terrible idea. I had clients before where they would tell me, Tommy, all my money is sitting in a CD and it's doing great. And I'm like, no, it's not doing great at all. You're losing money. Look at it. All right. And then they would be shocked, but they wouldn't really know exactly what to do with the money. And when I would explain it, it would make sense, but they would always be kind of very risk averse. And you got to be careful because sometimes taking on a little risk is a lot better than losing like 3% or 9% right now to inflation, because your money is going to be worth a lot less in the future. So by this video, you'll get everything, all right? As always, guys, like this video on top, also subscribe and hit the bell so you get notified. Now, the very first thing is, guys, when I say you should have money in a bank account for temporary reasons or, for example, for liquidity reasons, what I mean is this. Obviously, whenever you get paid, you gotta pay some bills, right? You gotta pay expenses, you gotta have some fun, you gotta pay some debts, you gotta do something like that. So overall, there would always be some money in there for those reasons. Money is gonna be coming in and out. But there's also one permanent reason, and that's usually going to be money for emergencies. And that's why the way I think about money is very simple. I think money has 6 jobs and all my money has a job. And here's why, because I realize that whenever I have money without a name, without a reason, all of a sudden that money gets spent, okay? Just gone. So I have $1,000 in that account for no reason. A month later, I don't have that money in there anymore, okay? It's gone. It's just spent and I don't know where it went, but it just left the bank account. So that's why I give money these 6 jobs. Job number 1 is money for emergencies. This money takes care of me in case anything happens, okay? Money for investments, okay? This money makes me more money and it works for me. So that way in the future, it can do all the work while I basically do all the play. Then I have money for paying off debts. This is money that comes in and is being paid out very quickly, very fast, because one thing about money for debt is that if you hold on to the money to pay the debt in full, again, the money usually gets spent or it gets used for some emergency. So it's very important that money for debt is used the minute you get in there to pay the debt, even before the bill is actually due. Then you have money for expenses. This is money that I use to live, and that has subcategories, for example, shelter, utilities, groceries, and transportation. That's my expense money. So that money is put to work to basically be able to live in this world full of expenses. Then I have money also for fun. The money I use to have fun. And Tommy, what do you do for fun? You're the boring guy. I shop on Amazon every now and then. And every now and then I get like an Apple Watch, you know what I mean? Which is usually used. And it's what I like. So it's my fun, all right? Makes me happy. Then you have, for example, money for charity. Whether you're tithing or you're giving money to some organization that you actually like or whatever it is, okay? So those are usually, for me, the 6 jobs I give money. And obviously a bank account is super important because it's where the money is going to land and where you're going to be able to distribute it accordingly. But as far as having physical money in your bank account forever, terrible idea. Inflation erodes the value, doesn't grow, no investment income, doesn't make any sense, okay? Just helps the bank out, doesn't help you out. But you will always have in there, for example, your emergency money and the money that lands in there to actually do different tasks with your budget. So here's a little system that I created as far as, for example, how to put this money to work and to actually build for you financial freedom and to buy assets and everything like that. Now, I gotta warn you, if you're gonna watch this whole video, you gotta watch it all the way through. And on top of that, I also gotta give you a second warning. Whenever you're trying to achieve something that not many people achieve, like less than 3% of people achieve, the answer is it's gonna take a while. I'm talking about like 10, 15 years or so. So you also gotta be willing to put in the work and to also understand that. It sounds complicated, it's simple, it's just hard to actually do day in and day out. So the very first thing is, guys, you want to save your first $1,000. You put that in a bank account, and that money is just there in case anything happens. And the job for that money is obviously emergencies, okay? Then you have, for example, to pay off your debts. So all the money that comes in, you use a portion of it to take care of yourself, and then the rest of it, you use it to pay off debt. Now, a question I get all the time is, Tommy, why wouldn't I use that money to make investments that could basically pay me money to then pay those debts? The answer is because basically, whenever you're investing your money, you usually carry some risks, and whenever that happens, if it does end up that that investment doesn't go your way or something happens along the way and you need to take the money out, you're basically putting yourself in a situation that you take on the risk of having to end it too soon, having to take money out, or if it doesn't go well, now you're just trapped with two problems. So that's why I always say first, pay off the debt, and then you deal with everything else, especially if you have, for example, any high interest debt, like a credit card, it's crazy, like 18%, you probably won't be able to make that in the market anyway, so it's important you pay those things off. So that would be the first part. $1,000, you pay off the debt, and just wait a while to invest. It's fine, don't worry. Then number two is, you save it for emergencies. Now, for me, you wanna have 3 to 6 months in there. For me, I have 12 months. I'm actually gonna make it 24 months pretty soon. And the reason is because basically, when you have money in there for emergencies, it's the money that enables you to basically move with freedom and a lot of confidence. Because if you have a job you don't really like, you're not really afraid if your boss fires you because you have 6 months worth of expenses to find another job that you also like, okay? So it gives you a lot of freedom, but not just that. It also gives you the ability that if something does go wrong with your income, you don't have to dip into your investments to actually take the money out. Notice I didn't say savings because I don't really save money for anything. It's usually just invested, all right? Unless I'm saving up money for a house or a down payment, then obviously that's different, all right? But it's the same thing. Emergency money keeps you from having to dip into your other priorities, all right? Now, number 3 here, very simple, is when you actually get into the buying of assets stage. And by the way, before I even get here, I do want to go back for a second and say, Tommy, shouldn't I put my emergency money into like a fund or an investment to make me some money at the same time? No, because that's money you want to have liquid at all times, because when the emergency strikes, you will not know the date or the time. So you just want to have that money available to you at all times. So if I had that money in the S&P 500, what would happen is, well, if that goes down, then I have less money than I actually need for my emergency. And like Murphy Law says, whatever can go wrong, usually will go wrong. And you ever had a problem, and the minute you have that problem, another problem happens? That's usually what happens. So you want to just keep that money liquid for that reason. Now, number 3 is basically the buying of assets. So my rule is very simple. As far as investing into the stock market or retirement, you can open up, for example, a Roth IRA, which is what I do, or for example, a Roth 401k, which is also what I do, or for example, if you just make a lot of money, you just put it, for example, into a brokerage account. But my actual investment is just into the S&P 500, and that's it, nothing else. That's an ETF or an index fund. That's the largest 500 companies in the US, and that's why I invest into it. Very diversified, and the risk is pretty low. It's kind of like saying, if you put all your money in there, you're basically saying, I think America is going to be better tomorrow than it is today, all right? That's why I invest into just the S&P 500, nothing else. So that basically means, for me personally, I put in 10 to 20% of my income. That's it. And I would do 10% if you don't own a home just yet, because the second asset you want to buy at this stage is going to be a property. And again, my rule is also very simple. You want to buy a property you can afford to buy and to actually own, not buy a property you can barely afford to buy and it's going to take you 30 years to actually own. That's not what you want. So my rule is simple. Make sure the property you actually buy within all the expenses of the property is no more than 33% of your monthly income. And on top of that, make sure you actually get it on a 15-year mortgage. For a lot of people, it's going to seem impossible, but it's not. It's just going to take a little bit more time to actually save for a down payment, 10 to 20% down payment, or it might take you to actually move somewhere else to actually be able to afford a home. But buying a home you can't really afford for the sake of owning a home is a terrible idea. Now, if you do this correctly, you should have extra money left over. Put that money not towards investing, but towards just paying off the home earlier, so that way you're done a lot faster. Question, I always get this. Tommy, wouldn't it be a better idea if I just basically use the extra money to invest and then use that money in there to basically put it into the to pay off the home? The answer is you could theoretically do that, but again, you're assuming that this investment is gonna keep going up and up and up, but it usually doesn't, because when it comes to the stock market, it fluctuates, and that's a part of the game. And the goal is leave the money in there to do its job, not take the money out to do other things in here and there. So, and by the way, you might be wondering, Tommy, why do you wanna own a home like so badly? The answer is I really don't wanna own anything. What I would really like is like not to have any bills, but one of the biggest bills that a person's gonna have in their lifestyle is gonna be like a shelter, right? Shelter costs are super huge. So if you own a home and all you're paying is taxes and insurance, your cost of living is so low where you can basically invest a lot more money and live a nice lifestyle. And that's why that's the end part. So towards the end, you're investing 20% of your money, but if you have no debt, you have a fully funded emergency account, and you also have, for example, no cost of living, like as far as shelter per se, like you just have a bunch of extra money. And with that extra money, you can choose to put that money towards either having more fun or having charity and all this other stuff, and that's pretty cool. And if you're wondering, Tommy, why didn't you give me a percentage for like how much you put towards emergencies, my investments, and the expenses, and the fun and the charity and the debts? The answer is because basically I have that in my full course, so the link is down below. But overall, I want you to be intuitive about what works for you best, because what works for me is very extreme and it might not work for you. So when I'm at the debt stage, or when I was there, I was basically just putting all the money I had towards that. And one big thing is that might not work for you. So you want to create a budget with those 6 jobs that works best for you. But the mission is, as it sounds, 4 missions. You have pay off your debts, save for emergencies, start buying assets, and then lastly, you get to kind of enjoy life as you go along, but you never stop investing. So overall, if you notice here, the only money we ever keep in a bank, a physical bank or an online bank, doesn't really matter. The answer is gonna be temporary money. It's the landing account where your money lands, and physically you always gonna have in there your emergency money. Now obviously, if you're saving up money for a down payment, that money is gonna be in there. If you're saving up any money for something that's less than 5 years, that money should be in there also. Like I'm gonna save up money, for example, to go on vacation, or a down payment, or my kids' tuition, like within the next 5 years. You might not want to put that into an investment account because it might fluctuate. And if it does fluctuate, it might catch you at the wrong end of the tail. And that's not good per se. But that's the overall idea, guys, okay? Never think a bank account is an investment account. It's the same idea of putting your money under your mattress. It just doesn't work. And I recommend the bank instead of that because the bank is safer, obviously. But it's the same trajectory as far as inflation. And never be fooled by the idea that, hey, Tommy, I'm making 6% APY here on the savings account. This is so cool. The answer is whenever that happens, like you make that much money in the savings accounts, is usually because we have inflation running rampant. So it doesn't help. It's just not a valid investment, like at all. It's just not an investment. So that's why I say. Okay, so have your money for emergencies and a high yield savings, pretty cool stuff. But understand, it's just a tool. A bank is just a tool to keep your money liquid and so on, but it's not a real physical investment. It doesn't appreciate whatsoever. As always, guys, thanks for watching. Like, subscribe, hit the bell so you're notified, and comment down below bank so I know you made it all the way to the end of the video. Up here is another video. Over here's my face, click subscribe, and as always, long-term team officially out.